Investing. What's that factor?
Hi and welcome to Investing What's That Factor, where I'll be talking about building some momentum into your portfolio. For those who don't know me, I'm John Sloan, financial planner here at Modulus Financial Planning. So, what is the momentum factor? In layman's terms, it is the tendency for assets that have performed well in recent times to continue to do so for some time into the future, in the short term at least. Imagine an oil tanker. You can't simply expect to turn off the engine and expect it to stop. Its natural momentum will take it on for a while further at least. And that's basically what the momentum factor is. It is when an asset continues to perform well or actually poorly because it has done so in the recent past. I should say here that the momentum factor shows up in all asset classes and is not necessarily limited to stocks and shares, although this is where it is used in the portfolios we recommend. The momentum factor was first identified back in 1993 by Jagadish and Titman, but it was 1997 when Mark Carhart incorporated it with the family French three-factor model. So what is a momentum stock then? In short, it's a popular stock. Well, the momentum factor generally looks at a stock's price movements over the last year or so, excluding the last month. The stocks are then given a momentum score. The higher the score, the more likely it is the stock to be bought. It's like a fashion designer in a way. They may release a successful summer collection of clothes and be the in designer for a while. The momentum here may well lead them to have a successful autumn and winter collection, but the spring collection the next year may be a different story as fashions change and the designer loses some natural momentum. As of the 30th of September 2021, some of the momentum stocks are Tesla, Alphabet, which is Google, Berkshire Hathaway B, Disney and Samsung. But why do these stocks outperform because of their momentum? Simply put, the main reason is generally put down to investor behaviour. Sometimes investors take time to react. If a stock is not performing well and some positive information is released to the market, then the market takes time to respond to this. An investor's behaviour is often to underreact. The result is that the downward trend for the stock may continue longer than it should. Its momentum takes it lower. On the flip side, sometimes investors don't react quickly enough, but when they do, they overreact. When a stock is moving upwards, then many investors may believe that it is doing well and will chase the returns, driving the stock higher than maybe it should go. This means there is a delayed overreaction by investors who herd together, all moving the same way. As such, the stock's momentum drives the price up a bit further from where it should possibly be. Both overreaction and delayed underreaction causes the stock to have a short-term momentum, either up or down. There is also a school of thought that the momentum factor can be explained in terms of risk and reward, which is the fundamental thinking when it comes to investing. It could be argued that recently well-performing stocks, past winners, face potentially greater risk going forward, and the momentum factor accounts for this and rewards you for this risk. Momentum stocks have certain characteristics, such as a higher turnover of stock, because the stocks gain and lose momentum fairly quickly in real terms. This means that the portfolio will have higher transaction costs, buying and selling the momentum stocks. That is why we only tilt towards momentum rather than trying to beat the market and absorbing these costs in portfolios. Momentum also has a negative exposure to small cap and value factors, and that is why we have them all incorporated into a portfolio. Momentum are also generally lower paying dividend stocks. The momentum factor is important to the overall portfolio. It works alongside the other factors to help drive increased likelihood of a positive investor experience. Not all things in a portfolio should be doing the same thing at the same time. If they were, then it would mean that the portfolio was perfectly correlated, and as an investor you would experience higher levels of volatility, and that is the value of the portfolio going up and down more often than it should. Due to investor behaviour, which is unlikely to change, it is almost certain that the momentum factor will remain. In the portfolios we recommend, it is basically a slight tilt to love stocks at a certain time. As Warren Buffett's mentor Benjamin Graham said, in the short run the market is a voting machine, but in the long run it is a weighing machine. Momentum factor in the portfolio helps to capture some of the popular votes, but we combine this with the long-term view of investing fundamentals. The stocks held in momentum factor aren't just chosen based on sentiment or what the current flavour of the month is. Stocks are identified via AI stock analysis using a rules-based investment approach. It isn't stock picking or using a hunch. This approach means that investors can benefit from the momentum factor by holding stocks with strong momentum and lower transaction costs. So that's the momentum factor. Hopefully this video has helped explain what it is and how it can be used in a portfolio. As always, if you have any questions in relation to this video or indeed any financial planning query, then feel free to contact us using the details at the end of the video. Thanks. Hopefully we'll see you again soon.